Have you ever heard the saying, the money is made when buying real estate, not selling it? It's a common phrase in the world of real estate investing, and it basically means that the key to making a profit in real estate is in the purchase price. Think about it. If you buy a property for a great deal, you have more wiggle room to add value through upgrades, renovations, or other strategies that can increase its value. This means that when you eventually sell the property, you can potentially sell it for a much higher price than you paid for it, resulting in a nice profit. On the other hand, if you overpay for a property, you may have a harder time making a profit, even if you make some improvements. That's why it's so important for real estate investors to focus on the purchase price. By doing your research, analyzing the market, and negotiating a great deal, you can set yourself up for success and maximize your potential returns. Of course, selling the property at the right time and for the right price is also important, but it all starts with buying the property at the right price. So if you're looking to make some serious dough in real estate investing, start by finding a killer deal and watch your profits soar.
In this video, we will discuss incremental exit potential, or as we like to call it, forced or active appreciation. So what this basically means is that when there is an investor who has deliberate, intentional, strategic ways to increase the property value above and beyond what the current market value is, that is putting in sweat equity, putting in effort. You are actively increasing the appreciation of the said property. The goal of forced appreciation is to increase the value of the property beyond what it would appreciate naturally. What this can do is you can get higher rental income, higher resale value, and overall a higher ROI no matter what metrics you're using. However, one caveat, if you over improve a place and it does not proportionately or disproportionately increase the incremental value, you can actually diminish your return on investment. So there is a sweet spot on how much to renovate for your forced appreciation.
There are several ways that investors can create forced appreciation, including the following. Renovations and upgrades. By making improvements to the property, such as upgrading the kitchen, adding a bathroom, or installing new flooring, investors can increase the value of the property. Repositioning. This involves changing the use of a property to increase its value. For example, an investor might convert a commercial property into residential units or vice versa. Next is increasing income. Investors can increase the value of a property by finding ways to generate more income from it, such as raising rents or adding additional units. If your property is zoned for nightly, 1, 3, or 6-month rentals, you can make 30 to 100% more rental income. But where can you find these properties? Well, that's going to depend on the location and the property type that you're looking into. So if you're interested in finding out more about where some of these opportunities are, you're going to want to reach out to me and I can help you out. Next is decreasing expenses. Reducing expenses associated with a property, such as lowering property taxes or insurance costs, can also increase the property's value.
Now that you have a better idea on how to create value in a property, let's go over an example. We're going to resort back to our Kitsilano condo.
First, we need to consider the expected renovation costs. One important note that I'd like to make here is that inexperienced investors generally underestimate both costs and the time taken to carry out renovations. So make sure you're getting proper guidance here or things can go sideways quickly. A tip I like to give to people is to always budget more than what you think it's going to cost, because no matter how well you've researched and planned, something always seems to come up. Our job is to mitigate that risk and ensure that if an issue does arise, that it's only a small one. And of course, ideally, not at all. But unfortunately, there's never any guarantees. Next, we've got the expected incremental valuation. This is a dollar figure that represents the amount that you estimate your renovations or changes to the property will have increased it by. Keep in mind this number also includes the costs associated with those changes. The key here is that you're looking to get the greatest return on your investment. Pro tip, upgrading the appliances usually has a close to zero improvement on the resale value, while having proper flooring can give you a 2-to-1 return on investment. If you want to learn more, email me for the cheat sheet on the top 5 best and worst investments to increase incremental value. Now that we have both the cost of the renovation and the amount that we predict it will increase the property's value by, we can calculate the return on investment. To do so, you will simply take the expected incremental valuation and subtract the expected renovation costs. This will leave you with a dollar figure that represents the gross profits you are expected to make. For this example, we see that $100,000 minus $50,000 leaves us with a $50,000 profit. Not too shabby. What we then want to do is turn that dollar figure into a return percentage. This can be done by taking the expected renovation costs and dividing it by the ROI dollar figure amount and then multiplying it by 100. So in this example, we see that we would expect a 100% return.
What sorts of renovations create the highest return, Alex? I assume it depends on your time frame, but what do you suggest?
Great question, Paul. To see the best returns in the short term, these are going to be things such as fresh paint, New flooring, updated lighting, and adding smart home technology are going to be the best bang for your buck. When it actually comes time to sell the property, staging and landscaping, if applicable, depending on what sort of property it is, can be a quick and effective way to increase the sale price of your home. Now, in regards to the long term, you're going to see the best return when making changes like updating the kitchen, bathrooms, taking down walls to open up the floor plan, and adding a suite if possible. All of which are going to provide you the best ROI in terms of renovations. Before we finish this video, we just want to leave you with a couple of key points to consider. Many investors who are new to the process choose to do the renovations themselves in order to save on labor costs. This can be a great way to keep more capital early on in your investing career, which can help you both mitigate your risk by reducing your costs, but it's also a cost to you based on your time. We call this sweat equity.
Another thing to be very aware of is that when you sell your property, you usually are taxed, and that's called a capital gains tax. One very important caveat with increasing the property value is that when you sell it, you usually will be taxed around 50%. So there are a few things to avoid this, and number one, please talk to a qualified tax accountant if you want recommendations. We have many of these. But before you do that, just know that there is actually something called a live and flip. And basically, it's off the rule that if you're doing the renovations while you live in the property, therefore it is your primary residence, there's a capital gains tax exemption when you sell a primary residence. As long as you're there at least for 12 months, there are ways to avoid this. Again, do your homework, but be very aware of what the end goal could look like for you.
On the tax side of things, it can get quite complicated, so this is definitely worth a further conversation. And after watching this video, if you're a little more curious now than before you started and want an insider scoop on places that give you a holistic ROI,
without your finances and mental health falling apart, book us below for a chat.